Hello, welcome to the essential ingredients for successful trading. The Fibonacci impulse wave strategies were developed and originated by Bernie Mitchell. The first step is to use the Fibonacci cluster locator to find levels of support or resistance based upon the previous trend. And then secondly, we find levels of support or resistance based upon a second discipline called the impulse wave pattern. And then we match these levels together to find highly profitable winning trade entries, and then wait for what is called a double squat to predict a market reversal and our signal to actually enter the trade. So first of all, what are Fibonacci clusters? In our opinion, the Fibonacci clusters are the most accurate method of locating support and resistance based upon the previous trend's actual formation. Unlike other Fibonacci software which take into account only the most recent high and low of the previous trend, the Fibonacci clusters take into account the swings or the pivots or the retracements within that trend. On this chart, for example, we can take a high point and a low point and connect them together with our trend line and turn on the indicator, and we will get four levels of, in this case, resistance. If you're looking at an uptrend, you'd be looking for areas of support. So in this downtrend, we have lower resistance, stopping point resistance, upper resistance, and finally maximum resistance. Now these levels are tentative levels where we will take trades, where we will take a short trade. But first of all, we must match them to what is called a point 1. And what is a point 1? It is an exact place on a chart where natural support or resistance takes place. And it is based upon a 5-wave megaphone formation. Now this is not the Elliott wave and should not be confused with the Elliott wave. But this is a 5-wave system where the 5th wave, in this case where we're looking for support, it'll be at the highest, where the 4 will be at the lowest point. We'll come up to another pivot point, which is the 3, which will be lower than the 5. We'll come down to a 2, which will be higher than the 4, and then up to a 1, which will be higher than the 2 but lower than the 3. And it is at the high of that bar of point 1 where we're looking for the market to come down to in order for the market to bounce off of it to go up. So a point 1 is an exact place on the charts where natural support and resistance take place. Now, on the other hand, where you are looking for resistance, as in our example we're going to be showing, we have, again, the 5 will be the low point, the 4 the high. We come down to a 3, which is higher than the 5, up to a 2, which is lower than the 4, and then down to the 1. And the 1, the low point of the bar on the point 1, that is our entry point to go short the market. That's where we anticipate the market to come up to go short. Now in this particular example, we can see that we have our 4 cluster levels here, and we wanted to match them up with point 1s. And in this particular case, we have a point 1 at the Fibonacci cluster lower level, the lower resistance level. The market hit there, came down. It went up to the stopping point cluster level to where there was a blue point 1 here, or identified by a blue point. The colors are really irrelevant. They're just used for ease of being able to communicate this. And then the market came down and then went up to the upper resistance where that cluster level matched up with the yellow point 1. And then the market came down, as you can see. Now in our example here, we can have a low of our 5, our 4, our 3, again, and then a 2 and a 1. And at the low point of the bar, it matches up with our stopping point level of our cluster, and now we wait. And also we must take into account that we need a double squat also. Now what is a squat? A squat is a proprietary frenzy warning indicator signaling a highly probable market reversal. Now on this chart you can see the double dots above and below the bars, and these are areas of probable market reversals. You can see sometimes they'll get the very top or the very bottom of different market swings here. And in some cases they don't work very well at all, and those would be in momentum moves. Now we identify what are momentum moves in our online video webinar so that you won't get into or use those. But basically, we just use the squats to get into the trades in conjunction with the cluster 0.1 matchups. Now in our example here, now this is the market. Again, we had our 5 or 4 here. This is our trend coming down, and we've the time has gone by here, and we actually see that the market has come up to our stopping point level here, which also corresponds with our 0.1, and now we have actually 2 bars that each have double squats on them to show that the market had a high probability of reversing direction. And sure enough, it did. So we hit our resistance level, had our double squat, and the market came down. And also make note of the yellow and the white dotted line here. We're going to cover that next. Now, as we mentioned about the finding support and resistance, that we want to look at the 2 most important aspects of profitable trading, and one of them we did cover, support and resistance, and the other is determining the true trends. That's where the yellow line and the white dotted line come into play. So we look at 2 indicators which determine the short-term trend and the long-term trend. The long-term trend is based upon a simple 89 moving average. Actually, it's more of a turbo than a simple because there is some extra other coding. You won't be able to get the same line if you just put a simple 89 moving average on there. It is more of a turbo moving average. And the short-term indicator is based upon an exponential 89 moving average. And in this chart here, you can see how we look at the market here on the 89 line. When prices are trading above this 89 line, we are considered in an uptrend. And when they are trading below it, we consider the market in a downtrend. Now, the main 89 line, the yellow line, is the literal battleground between the bulls and the bears. And this dotted line here is the exponential 89 line. We can see here where the main 89 line supported the market, and as we broke above it, we came down, and the exponential 89 line became the support for the short-term trend up. And then finally, it broke down below the fast 89 line, tried to break through, couldn't. It was then resistance, came down, and found support at the main 89 line. And again, these happen over and over again. Now here on the short side, while we're in a downtrend, you can see that the market came off the 89 line, tried to break through the 89 line twice, came down through the fast 89 line, and then the short-term trend became down, whereas the fast 89 line became the area of resistance. Finally, it broke through the resistance area of the fast 89, the short term, and came up to the longer-term trend and could not break through. And then the short-term trend became the support level. Again, broke through the main 89 line. Now we have support to the upside and have changed the trend to the upside in this particular example. And we like to find trades, obviously, which are, when we want to go long, we'd like them to be above the main 89 line. And when we want to be short the market, as we were in our previous example, that we came up to where actually the main 89 and the fast 89 line came together, which gave us a real high probability of the market reversal, again, with the squats and the matchup between the cluster level matching up with the 0.1s. Now we have another indicator which we use called our ADX histogram. And this will show you when a big move is ready to begin, when a trend is likely to be over, and when there's a false breakout. Now I'm going to go through this briefly. It may be difficult to see, but there are 2 red bars where these blue arrows are pointing to. And this means that the market's been going sideways forever, and it's about ready to make a big move, either up or down. Now, in our online video webinar, we do show you how you can tell the most likely or what the most probable direction will be for the market to break out, either up or down. And anyway, the market will break, and as in this case here, the market trended up, and you can see the ADX histogram also trended up until it got to a threshold and moved down and created this white bar here. that means that this trend was most likely over. And again, with the second bar, that confirmed that the trend was most likely over. And these can be very valuable, again, in your trading when you're looking at different areas of support and resistance confirmed by these different indicators. And again, when the market's going sideways for an extended period of time, you'll get a series of these yellow bars, which seem to be about 70% correct. They tell us when there's a fault breakout or breakdown. For example, this line right here, people may be shorting the market at that point. Well, you get this yellow bar. It says that it's not going to continue in that direction and actually turns up. People may be looking to break out there and it turns up. So anyway, you can get a series of these on any particular day. Now, we invite you to explore our website, again, www.feargreed.com. We have back issues of our newsletter you can explore and as well and look at our track record.